Howdy, partners. Today we are talking about Cannibal Stocks. And these can be really amazing investments. These are the businesses that keep buying back their own stock. And the major benefit here is that you get the same great business, the same profits, but every time they buy back shares, you get more ownership per share. And Charlie Munger loved cannibals. So here's one of my favorite quotes from him. He says, "Pay close attention to the cannibals, the businesses that are eating themselves by buying back their stock." So that gives you the reasoning behind the cannibal name. And you may wonder, TJ, why are you talking about cannibal stocks? Aren't you a dividend investor? And isn't this a dividend investing channel? Well, yes, but as much as it pains me to say it, there's more to life than just dividends. So this is a chart of the S&P 500. Now this goes to 2022, but if this were extended to today, the trends that you see would very much continue. So the red line is the index. The green bars along the bottom are how much capital has been returned through dividends. All right, you can see that's fairly stable. It dips a little bit there during the great financial crisis, 2008, 2009, but that's more stable than the purple bars. Now, the purple bars are how much capital is being returned through buybacks. And you can see during times of stress, again, the 2008, 2009 crisis, during 2020, you can see the buybacks tend to dip. But if we look back from the great financial crisis, if we go from that dip in 2008, 2009, and look, the trend in the purple bars is very much up, and that is growing faster than the green bars. And like I said, if this were extended out through today, that trend would absolutely continue. There are more dollars being returned to shareholders on buybacks than dividends at this point. Is that always my preference? No. It depends on the company. It depends on why they're buying back stock, what price they're buying it back at. But the fact is, companies are spending more on buybacks than dividends at this point. So if we ignore them, we're missing part of our returns and part of the cash that's coming back to us as shareholders. But there's another really good reason to pay attention to buybacks, and that's because shareholder yield tends to outperform dividends alone. Now, what do I mean by shareholder yield? Well, shareholder yield is a combination of dividend yield plus a buyback yield, plus most sources also include a debt paydown, which, if you think about it, it makes sense. If a company pays down debt, less money goes to interest and principal payments. That means higher earnings, which in effect is the same as a buyback. It raises the EPS. So if we take those three things together into account and look for companies that give us high quality shareholder yield, we actually tend to do better than if we just look at dividend yield alone. And you can see dividend yield, shareholder yield, and the highest quality shareholder yield all did better than the S&P 500. Manish Pabrai has done some really great work on cannibals. He's kind of developed a framework that he calls the Uber Cannibal Investing Strategy. And here's kind of the summary. So for a cannibal stock and a cannibal investment to work, you need stable or growing profits for 20 years or more. So the reason is because if a company's buying back, 2 or 5% of its shares every single year, you need some time for that to really decrease the share count to where it makes a big difference and gives you an attractive return. And for that to happen, obviously, we can't have declining profits. They would be able to buy less and less shares back each year. That being said, cyclical companies are okay. The biggest thing to make sure of is that they can survive the bad times. So with cyclicals, they can be an interesting cannibal company. A lot of the time what happens is they kind of have this sort of fixed operating cost, right? And during the bad times, during the low points in the cycle, the profitability may dip. They may not do as well. And you won't see a lot of buybacks. But what happens is that during the upswings in the cycle, when these companies are making a lot of money, those fixed costs don't go up. So they have all these excess profits and they can buy back shares at that point. Now, the really smart ones bank the cash and wait for the cycle to dip and the share price to fall, and then they kind of take advantage that way. But ultimately, what it comes down to is earnings growth, the valuation numbers, and the number of shares they retired. That's what's really going to dictate your success with this strategy. So again, after 20 years, the four things that matter. One, how many shares are gone? How many shares did this company actually retire? And one thing to watch is there are companies that buy back shares pretty frequently, pretty regularly. But if you look, they're not actually retiring shares. Some companies just buy back basically to mop up stock based comp for their executives or employees. So, what we're looking at is the number of shares that have actually decreased. Number two, the earnings growth rate. Again, we need that at least stable, preferably growing. The more earnings, the more shares the company can buy back. Number three, is the business still strong? Has it survived those 20 years? Has it come through with strong earnings? And is it something that the market is still going to want, which leads us into number four? What's the current valuation? So, the way that these work the best is if the company can be buying back shares at a low valuation. Like if a company can kind of be underappreciated by the market and selling at a low PE, that company can buy back more and more shares. And we love that during the time we're holding. But once those buybacks have been completed, once the share count is down, significantly, to really get a great return, if we can get a multiple re-rating on top of the share buybacks, then we have two things really driving our returns. And if the earnings growth has been strong, well, that's a third lever driving returns. These can really turn out to be amazing investments. And the most important rule is never invest in cannibals with an uncertain future. Again, we need those stable earnings, we need a long period of buybacks, and we need a reasonable multiple, at the end of this period. And if we get all those things, you can wind up with a really amazing investment. And I can hear you all asking through your computer screens and yelling into your phone, TJ, how awesome of an investment can these be? Well, fortunately for you, the next slide's an example. So AutoZone's a great example of a great shareholder yield company. And AutoZone is actually a pure cannibal. So between 1998 and 2024, AutoZone bought back more than 88% of their shares. And you can see the share count here. This is impressive. 152 million shares down to 17.1. That was almost 89% of their shares bought back. And like I said, this is a pure cannibal. They paid zero dividends through that entire period. And split adjusted, that price went from $27 a share to over $3,000. Now, I just went with 2024 because that's a period that's known. We don't know how things this year are going to end, and I don't know where the stock price is going to go. But for those of you watching in Futureland, as of today, when I'm recording this video, AutoZone is actually $4,000 a share. So there's been another $1,000 per share added between 2024 and today. And that works out to 113 bagger. But the earnings only went up about 12 times. So the return on this stock, 12 times your money would have been good, but the buybacks drove it to 113 bagger. The buybacks alone really made this return 100 times the money that you would have invested back in 1998. So if that doesn't get you excited about the potential, I'm not sure what will. So the next thing we're going to do is we're going to run a screen to try and find some of these companies like AutoZone that can turn into really amazing investments. And I'll show you quickly the criteria I'm going to use, and then we'll go to fiscal and we'll go ahead and run it. But we're looking for a company that's reduced its share count by at least 2% every year over the past 5 years. We're looking for that growing revenue and earnings at least 5% a year over the past 5 years. And again, using a 5-year average, we're looking for ROIC of at least 8%. So this is going to give us, hopefully, some of those quality, stable, growing companies that if they keep buying back those shares, should do well in the future. So let's go ahead and hop over to fiscal, and I'll show you how to run this screen. Okay, so here we are on Fiscal AI. You can see how I've set this screener up, and I'm running this screen basically on the US, the UK, Europe, Australia, and Japan through the Tokyo Stock Exchange. So right here we have the shares out growth over the 5 years. The max I have is -2. So that's going to give us companies that have decreased their share count by 2% per year or more over the past 5 years. Our ROIC, revenue, and EPS CAGR minimums. I'm not including dividends on this, but you certainly can if you want companies that also pay a dividend. Let's go ahead and run this screener and see how many companies we get. 177 companies meet this criteria. So you can see some not so surprising names. Apple, great investment Buffett made, a lot of that driven by buybacks. Google is buying back some shares. Meta, MasterCard, American Express, um, Applied Materials, HCA Healthcare, pretty well known. Cannibal Stock, a lot of interesting companies. O'Reilly Automotive, similar to an AutoZone. There's AutoZone right there. Still buying back shares. So what I'm going to do is I am going to actually put these companies into a spreadsheet for you. And if you want to download this entire list, I will put the link there. And the way I'll filter this is if we actually go like this will tell us who's bought back the most. Look at that, 124%. Don't know this company out of Japan, but that's an impressive. Whoop, I did ROIC. My fault. Or did I? No, I did shares out. I'm okay. Still 31%. That's impressive. That's a lot. AutoNation, Avis Budget Group. Interesting. Did not know they were that big of a share cannibal. Grand Canyon Education. Am familiar with that one. They do tend to buy back a lot of shares. So, like I said, if you want this entire list and a downloadable spreadsheet, grab it in the description below. Hope you enjoyed it. Hope you learned something. Thanks for watching, and I'll see you in the next video.